All right, in this video from SuperfastCPA, we are going to go through some MCQs, and we're going to go through FAR Area 2 in E from the blueprints. That's where this is coming from. Under investments, and how to calculate investment income that is recognized in net income for investments measured at fair value. Okay? So, as you know, or maybe you don't know, if you're just coming across this, you've never seen anything from SuperfastCPA, our approach in a nutshell is that the best way to learn the material for test day, which is what matters, is by learning primarily from the questions and simulations. So we're just jumping straight into some MCQs and walking through these. Now, if you're watching this on YouTube, we're going to go through the first 5. So by definition, they're free. You know, it's on YouTube. And then as we record these videos, we actually have 10 questions that we'll go through. And those are in our members area for SuperfastCPA customers. And if you want a bigger picture or a more in-depth overview or explanation of our study strategies, which, again, there's a lot that goes into the study process and doing it effectively. Our whole approach is based on the idea that every little aspect of the study process, whether it's how you approach MCQs and, you know, dissect, make sense of, reverse engineer MCQs and make sense of the solutions, whatever you want to call that, there's very effective ways to do it, and then varying degrees that are less effective. Same thing with how you approach and deal with practice sims. Same thing with how you take notes, or our approach is making your own flashcards, really making sense of questions and simulations, putting them into your own words. Anyways, the whole idea is there's varying levels of effectiveness for every aspect of the study process, like your final review, when you study. Anyways, so you do the most effective version of every part of the study process, and you're layering together these advantages. And then it gets to where your study process can be so effective and efficient that it's really hard to go wrong. So our free training webinars is where we give a pretty in-depth overview of our study strategies and how it all fits together. Really, there's kind of 6 core strategies that if those 6 things are present in your study process and you're doing them effectively, it's really hard to go wrong. So the link to those free trainings will be down in the description of this video. So with that out of the way, let's go into this first question. Okay, so XYZ Corp holds several investments in debt securities. Now, just the way that I read questions, or I guess used to do it, or the way we teach people to do it, you go straight to the last sentence of the question prompt, because that's like the real question, and then you can go back and read the whole thing. So, which of the following statements correctly describes the accounting treatment for these investments during the year? Okay, so it's one of these things where, you know, one of these is describing it correctly, and you have to know, like, this is going to be mostly conceptual, it looks like. All right, so they hold several investments in debt securities. Among these, it has a $1 million bond that it classified as an AFS investment, and another $500,000 bond that it classified as held to maturity. At the beginning of the year, XYZ decides to elect the fair value option for the HTM bond. The AFS bond continues to be measured at fair value under the fair value method. Okay, so, I mean, for your purposes, again, this whole approach of trying to learn from the questions, you're kind of looking at questions as almost it's a hokey example, but like a detective. So we have 2 things mentioned here, the fair value option and then the fair value method. So we'll get to that, but then we have the real question. Which of these statements correctly describes the accounting treatment for these investments during the year? A, the changes in the fair value of both the AFS bond and the HTM bond will be recognized in OCI. B, changes in the fair value of both the AFS bond and the HTM bond will be recognized in the income statement. C, the changes in the fair value of the AFS bond will be recognized in other comprehensive income, OCI, while changes in the fair value of the HTM bond will be recognized in the income statement. Or D, the fair value option election for the HTM bond means that it will continue to be measured at amortized cost with no fair value adjustments. Okay. Now, as you're watching this video, the way that you'll get the most out of these is right now this one's just conceptual. So if you have no idea about this topic, but anyways, as we go through and we're about to reveal the answer, pause the video, but especially as we get to the calculation-based questions, pause the video, make your own attempt, and as we go through question by question, you should have like building blocks that start kind of stacking up in your understanding. And so as we get to like question 4 and 5, you should be able to make a decent attempt, even if this is your first time seeing this topic. That's how the question first approach should work if you're doing it correctly. But anyways, so pause the video, reread this if you need to, make your best guess, but especially as we get going on the calculation-based ones. Okay, so we will reveal the answer here. So the correct answer is C, all right? Changes in the fair value of the AFS bond. Now, you remember AFS securities, their changes in fair value go to OCI. While the changes in the fair value of the HTM bond, which we are now, XYZ company, they've elected the fair value option. So that will be, the difference is that once you make that election, any changes in the fair value of that investment at the end of the reporting period is reflected in the income statement, not OCI. So the fair value method right here, this question tests the understanding of the difference between the fair value method and the fair value option. So those are two different things. The fair value method basically just means what you're probably used to, again, depending on how much of this you've studied already, of just how you would treat trading securities and AFS securities. And so under the fair value method, the financial instruments are measured at fair value, but the treatment of the changes in fair value depends on the classification of the instrument. So trading securities, those changes in fair value are recognized in the income statement. Whereas AFS, available for sale securities, those changes in fair value are recognized in OCI, not the income statement. Now, when that security is either impaired or sold, then those changes that have been sitting there in OCI, then they get recognized through the income statement. But going on to the fair value option election, so the fair value option allows a company to elect to measure any qualifying financial asset or liability at fair value with all changes in fair value recognized in the income statement. This election overrides the standard classification rules, basically what's under what we just talked about, the fair value method, and can be applied to instruments that are normally carried at amortized cost, such as HTM securities, or those that would typically have changes reported in OCI, such as AFS securities. Once elected, the fair value option is irrevocable. So the fair value option is irrevocable unless a new election date occurs, and that would be something like debt restructuring or a business combination, something like that. So another just comparison to kind of set the stage for the remaining questions or give you more understanding. So for an AFS bond under the fair value method, so an AFS bond is measured at fair value, but the fair value changes are recognized in OCI. So that means the unrealized gains or losses do not impact the income statement until the bond is sold or impaired. An HTM bond with the fair value option, so normally a bond or an HTM bond would be carried at amortized cost, meaning no fair value adjustments would be recorded. However, once, in this example, XYZ elects the fair value option for the bond, it's then measured at fair value, and all changes in that fair value are recognized directly in the income statement. So this approach is overriding the typical accounting treatment for HTM securities. Okay, so going on to question 2, and we'll go straight to this last sentence. How much income related to this investment should Zenith recognize in its year 1 income statement? Okay, so we're looking for how much income they're going to recognize. So year 1, January 1, year 1, Zenith Corp purchases 25% of Omega's common stock for $500,000. During year 1, Omega, the investee, reported net income of $100,000 and paid dividends totaling $40,000. By the end of year 1, the fair value of Zenith's investment in Omega was $520,000. So Zenith Corp elected the fair value option for this investment. So how much income related to this investment should they recognize in their year 1 income statement? So now, as an example of how these, questions, as long as you're making sure you're understanding the solution to each one by one, making sense of it, your understanding builds on each progressive question. So from question 1, we got the info that when the fair value option is elected for an investment, the changes in fair value are recognized in the income statement for that investment. And also, the dividends their portion of the dividends would be recognized in income as well. So I gave you too big of a hint on that one. But just from that, try and make an attempt on this question. You should probably be able to get there. So A, 10,000, B, 15,000, C, 20,000, or D, 30,000. So pause the video, make your own attempt before we go through the solution. Okay, so going through the solution, the correct answer is D, 30,000. So let's read why. Under the fair value option, this is going to be recovering what we just talked about in question 1. Investments are measured at fair value, and all changes in fair value are recognized in the income statement. Despite holding 25% of Omega's stock, which typically suggests significant influence and would normally require the equity method, that's another just little nugget of understanding you can take. So that means that even if an investment normally would qualify or need to be treated under using the equity method, the fair value option election can override that. So because they elected the fair value option, that just means that the equity method doesn't apply and the changes in fair value and dividends are recognized directly in the income statement. So for the calculation, this is pretty simple. We have, the $520,000 by the end of the year. That's what the investment was valued at. We started at $500,000, so we have that $20,000, and then 25% of the $40,000 of dividends. So you have the $520,000 of fair value minus the initial cost of $500,000, $20,000, plus the dividend income. 25% or 1/4 of $40,000 is $10,000. So we have $30,000, which was the answer D. Let's see if this is anything different. Yeah, so this is exactly what this covered. So, all right. So that's fairly straightforward. It should be fairly easy to understand when the fair value option is elected. So let's go on to question number 3. Okay, question number 3. Let's start with the last statement or the last sentence. In its income statement for the year, what amount should Blake report from its investment in zinc? Okay, so we've got the same setup as the last question. Blake purchased 15,000 shares, giving them 3% ownership of Zinc Corporation on January 15th for $450,000. Blake did not elect the fair value option. On June 30th, Zinc declared and distributed a stock dividend of 1,500 shares when the market value per share was $30. On December 31st, the market value per share was $32. Additionally, Zinc paid a cash dividend of $1.50 per share on December 15th. Blake classified its investment in Zinc as available for sale. In its income statement for the year, what amount should Blake report from its investment in Zinc? So again, from the info we covered in questions 1 and 2, you should hypothetically, you should be able to answer this. So pause the video and make your own attempt before we go through the solution. Okay, so let's go over the solution here. So the correct answer is B, 24,750. So let's see how we got here. So this question tests the understanding of how dividend income and changes in fair value are treated differently depending on whether an investment is classified as a trading security or an AFS security. So for the calculation, the cash dividend, so let's go up here and explain this a little bit more. So because this is an AFS security, and the question is, in its income statement for the year, what should they report from this investment? The change in the fair value doesn't apply. Like that change would go through OCI. So the only thing that they're going to be recognizing in the income statement is the cash dividend. But there was this little wrinkle here where, they had 15,000 shares and then they got 1,500 more. And so really the answer to this question is just the 16,500 shares times $1.50. And that's what they would be reporting in their income statement. So the dividend income, the 150 times the 15,000 shares, these are the original shares. The cash dividend on the stock dividend shares, 150 times the 1,500 additional shares. So you got 22,500 plus 2,250 for a total of 24,750. So the stock dividend shares, they don't generate income. They just increase the number of shares that, what's our fake company called? Blake is holding. And the unrealized gain, that change is that's irrelevant to what the question was asking because it says they're holding this as an AFS security. So, like I said, from questions just 1 and 2, you should have been able to get to this answer. All right, let's move on to the next question. Okay, so question 4, the actual question's going to be the same, basically. What amount of income or loss attributable to the Orion stock investment should be reflected in Larson's year 4 earnings? So during year 3, Larson purchased 10,000 shares of the 1 million outstanding shares of Orion Corp's common stock for $50,000. At the end of year 3, the fair value of this investment was $48,000. During year 4, Larson received $2,000 of dividends from its investment in Orion stock. The fair value of Larson's investment on December 31st, year 4, was $45,000. Larson has elected the fair value option for this investment. What amount should they recognize in their income statement for year 4? Okay, from this investment. So again, you should be able to get to this answer from everything we've covered. So pause the video, make your attempt, and then we'll go through the solution. All right, so on this one, if you read this carefully, during year 3, so year 3, because this is asking about year 4. So year 3 is, well, it's not irrelevant, but the main thing to take note of, at the end of year 3, the fair value of the investment was $48,000. So for what we are trying to answer, that's our starting point, $48,000. During year 4, they received $2,000 of dividends, okay? So we know that would be income, right, from the previous questions. But by the end of year 4, that investment that started at $48,000 has gone down to $45,000. So that's a loss of $3,000. So netting the dividends of $2,000 with the loss of $3,000, our answer should be B, a loss of $1,000. So let's reveal the answer here. So the answer B, the loss of $1,000. I mean, this is, again, if you understood the three previous questions, this is fairly straightforward. So we don't need to read this whole explanation. I think you get it. They received the $2,000 in dividends. That would be recognized as income, except for the fair value decrease from $48,000 to $45,000. So you net those two, $3,000 loss, the $2,000 of dividends, you're left with a $1,000 net loss. That would be, I guess, taken away from their income in the income statement. So let's go on to question 5. All right, so this one is trickier. And you may not, you're gonna have to pull your bond knowledge to get this one right. So, but we did mention bonds a little bit in question 1. Anyways, so we'll go straight to the real question, which, because we're all it's on the same topic, it's basically the same. So in its December 31st, year 5 income statement, what amount should Bailey report in earnings as a gain or loss on the bond, disregarding interest, if it elected the fair value option on January 2nd, year 5 for this investment? So reading the question back, on January 2nd, year 5, Bailey purchased a short-term investment, a $500,000 face amount, Delta Co. 9% bond for $480,000. So they purchased that at a discount to yield 10%. The bonds mature on January 1st, year 12, and pay interest annually on January 1st. On December 31st, year 5, the bonds had a fair value of $495,000. On February 15th, year 6, Bailey sold the bonds for $490,000. And then, of course, in its December 31st, year 5 income statement, what amount would be reported in earnings as a gain or a loss on the bond if it elected the fair value option? Okay, so pause the video, use your best understanding from the questions we've been through, and make your attempt at this question before we go through the solution. All right, so a few things before we reveal the answer. Just as a question reading tip, you're always trying to identify what is actually relevant to the actual question. So this is asking for year 5, what would they report? So this year, what does it say? In year 6 that they sold it, that is not going to have anything to do with what we're trying to figure out with this question. So let's see the solution. So the correct answer is C, a $12,000 gain. So let's read why. So given the fair value option election, the bond will be measured at fair value. Now, from the previous questions, you might have just taken, because it says disregarding interest, but it's, what that is referring to is for the income amount, we're disregarding the interest income from the bond for the purposes of this question. What would you report as far as the fair value option election from this bond? So that's what the disregarding the interest means. You do have to factor in the amortization of the bond for that year. And the way that you do that, is, well, we'll get to it. What I was saying is, from the previous questions, you might have just said, from $480,000 to $495,000, you would say it's a $15,000 gain. Okay, but so here's the wrinkle and why I said you need to pull in your bond knowledge for this. So to get the amortization of the discount, because our investor company, Bailey, they bought the $500,000 face value bond for $480,000. So as that amortization as that discount is amortized, because it's a discount, we're going to be adding back to the original value. So anyways, here's the calculation on that. So for the amortization of the discount, you take the interest revenue, or the effective interest, which is $480,000. That's what they actually paid for the bond. Excuse me. That's what they actually paid for the bond, times the 10%, which is the yield rate, and then the coupon rate was 9%. So you got $48,000, but the cash interest received, which is on the face amount times the coupon rate, so $45,000, you subtract those two, and so the amortization of the discount, we amortized in that first year $3,000 of the discount. So the carrying amount by the end of the year is $483,000. And there's two ways to look at that. You could take the amortization of the discount and just make that fair value change calculation. So the 480 to 495, 15,000, and subtract the 3,000. That's how it works better in my head. But what's actually happening is you're adding that amortization of the discount back to the face, or the carrying amount of the bond. So you're really using $483,000 is the main point. When you look at the ending fair value of the bond, sorry, not 490, the 495 minus 483,000. That's how you get to the $12,000 gain. So you have to do this little thing where you're doing the amortization of the discount. And if we're dealing with a premium on the bond, it would be the exact opposite. So you'd be subtracting a number from the purchase amount because you would have purchased it for more than the face value. So anyways, just to go really quickly to go over the steps to calculate the amortization of the bond discount, you are going to calculate the interest revenue, meaning the effective interest. So you multiply the carrying amount of the bond, the amount actually paid, plus any previous amortization, by the effective interest rate, which is the yield or the market rate at the time of purchase. Then you calculate the cash interest received, what the bond's actually paying. So you multiply the bond's face value by the coupon rate, or the stated interest rate. Then you subtract the cash interest received from the interest revenue calculated. So this difference is the amount of the discount that was amortized, because all it is the discount being spread out over the life of the bond. That's the amortization. So then you add the amortized discount to the bond's carrying amount. And then this adjusted carrying amount brings the bond's book value closer to its face value over time. And again, the premium would work the same way, just opposite. So those are the 5 questions that are free if you're watching this on YouTube. And so if you found this helpful, for all these topic videos we have, there's just an extra 5 questions. And the way that we do these are we kind of repeat the question types again with different fact patterns, so that the first 5 questions, the idea is it's kind of teaching you the basics. Well, it's just teaching you how the main question types you'd see on this topic. And then the remaining 5 questions, questions 6 through 10, that'll be in our members area, gives the user the chance to really just reinforce what they learned and kind of test themselves. Like, okay, if you feel like you understood the first 5 questions, can you get the remaining 5 questions right? And if so, now you have a really good understanding of the main question types you will see for this topic, versus watching a video lecture, thinking you understood it, and then going to the practice questions and realizing you still have no idea how to actually answer the question types for that topic. So hopefully you found this helpful. Again, if you are just finding this somehow randomly on YouTube and it's the first thing you've seen from us, I cannot recommend enough to go to the description, find the link to our free training webinars where we describe the overall study process, because how you pass on test day comes down to the effectiveness of your day-to-day study process. most people are focused on the amount of hours spent studying, whereas like that is not a very reliable calculation. You can't just say, yeah, if you stare at your review course for 200 hours, you'll definitely pass. Not every study hour is, equally effective. A lot of people are dedicated, spending a lot of time, but spinning their wheels, doing things very ineffectively that they don't even realize. So anyways, before I go on a diatribe about the study process, the best place for you to start or get a really in-depth overview of how we recommend you approach the study process is one of those free webinars that the link is down in the description. And then, of course, on those webinars at the end, like we just cover really good information that you will find helpful. And at the end, we do give a discount to our products, but we really only do those from those webinars, or we really only give out the discount from those webinars, because we want you to judge for yourself if the ideas we're covering make sense to you before you purchase. But if you found this video helpful, there's a lot more of these in our members area. And thanks for watching. And, if you found this valuable, the best thing you can do, since this was free, is to like the video, maybe leave a comment if you found it helpful or whatever, leave a comment. And then we put out a lot of helpful stuff on our YouTube channel. So subscribe to the YouTube channel, and then also check out our podcast, because we have 150 plus interviews from some of our past customers. So we have a lot of interviews where we just talk about someone's study journey, how they got through the study process, what worked for them, the things they realized that were mistakes. Those interviews are just very, very helpful. So that's on the SuperfastCPA podcast. So anyways, thanks for watching, and we will see you on the next video.